Here to discuss that is Adam Parker, founder and CEO of Trivariate Research and a CNBC contributor. Adam, good to see you.
Thanks for having me.
Why don't we start from the top down here before we get into kind of what the market was really up to in the first half? I know you've done some work on that. Fed minutes kind of give us the message we got from Powell in the press conference of we paused. Majority, of course, unanimous, saying we're not going to do a rate hike this time, but we're leaning in that direction. We're going to try to be more patient about it. But then you had some people saying we still think the economy is vulnerable. So you have these kind of push-pull dynamics within the Fed. You have Treasury yields, the 10-year, almost to the highs it was before SVB, 2-year as well. Is that a comfortable level for the equity market?
It's a very strong, statistically significant relationship between Fed fund futures and the multiples, the price to earnings for equities. And so you would think that if it's hawkish relative to expectations, that would be bad for the market. And lately, there's been this almost negative skew where they get hawkish, the market doesn't really go down, but if they say anything remotely dovish, the market rips higher. Right. So that's usually a sign the market wants to go higher. It's very hard, though, 44, 49. It's hard to sketch out 10% upside to the market from here and say, okay, I can believe in 5,000 based on earnings and multiples. So I think you need, if they get dovish in reality, it's because the earnings in the economy are worse. So we started the year bullish in the first half, more cautious in the second half, and I'm kind of sticking with that call because I feel like the risk reward is more maybe up 10, down 10 now than it was maybe 6 months ago. Yeah,
so bearish in the second half, or at least feeling like there's some payback to be had.
Yeah.
I know you looked at, this leadership, talking about stocks that have been relatively impervious to what's happening with yields. The big mega cap names that everyone has been fixated on have been contributing a lot of the upside. What has the market been rewarding specifically when it's been adding tremendous amounts of market cap in that area?
Sometimes I think we all are guilty of, it's like a 20 variable problem. We try to isolate the one so we can understand it. Yeah. But I made this chart and I'm like, maybe this is the one, right? When CPI went up, when inflation went up, it hurt the margins of every company except for the biggest 50, except for the mega cap growth stocks. So if you look back, like the gross margins of those companies didn't really go down, right? The small caps, mid caps, they got kind of killed. So, at the end of the day, that relationship, you can see it, the blue line there, like the big companies didn't get their margins hurt. So I think the case for the market being maybe bullish, the more optimistic view would be, okay, well, some of those headwinds to the small and mid-cap companies, the commodities are down, inflation starts abating, those are the input costs. Maybe the market could broaden by some of these guys participating as the margin pressure abates. That'd probably be the bull case to get you to 10% higher. But, I wouldn't say that's the base case.
Yeah, these guys meaning like everything but
the biggest 50 names
that have seen some margin hits taken.
Right.
But in terms of those mega caps, so the market is rewarding the durability of profitability in a sense. Forget about it's all about real yields, it's all about the cost of money or the Fed, whatever. Everything fits into it. But I also feel it's interesting because if I look at a chart like Apple, and I just see this crazy linear 45-degree angle of ascent we've had till recently, it's pulling back today. It shows you that the market is just migrating to this, not as a company with all these different variables that it's sorting through on a day-to-day basis, but it just wants to own this category of asset.
Yeah, look, it's $3 trillion round numbers. It added, we noticed in our work, there's only 20 companies in the U.S. that are even bigger than $300 billion. So if Apple goes up by 10%, which it almost did in June, it adds Home Depot-sized company in 1 month.
The 31st biggest company.
Yeah, it's massive. So to me, if you're trying to index your portfolio against the S&P 500, you just have to kind of manage your risk around these biggest 6 or 7 names. I don't really think you can know something about Apple that's not in the price, that you're going to do research and you're going to understand something. I mean, it's the most covered security in the world. And who knows, maybe $1 trillion of the $3 trillion value is their data and some potential intelligence they can get from the data. So how do you value that?